Hello, everyone. Welcome to the course of Momentum-Based Trading. My name is Xiaolei Xie. At my day job, I am a senior quant modeler at London Stock Exchange Group. Today, I would like to give you an overview of the course. I will tell you what momentum-based trading means, how we can build a momentum-based trading strategy, and how we can be confident that our strategy works. So first of all, let me explain momentum-based trading. In the simplest terms, momentum-based trading means when there's a clear trend, that is, a momentum is a price movement, we see the opportunity and buy the asset if the price is trending up, or sell it if the price is trending down. For example, in the case of Zoom, we would ideally want to buy the stock in January 2020 when the price starts to pick up and sell it in September when the price peaks. Later, in 2021, we want to buy it again in April and sell it in May. But of course, this is much easier said than done. How should we detect an upward or downward momentum? How much of our capital should we commit to the trade? And how much risk will we take in so doing? We will answer these questions using a mathematical model. And if math formulas look scary to you, don't be afraid. I will show you how to code the formulas into a Python program that will give us answers to these questions and help us make informed trading decisions. So a widely used model of asset price is a geometric Brownian motion. It is a stochastic differential equation. The symbols in this equation are as follows. The ST means the asset price at time t. WT symbolizes the random part of the asset price movement. It is called a Brownian motion. Here, mu is the drift coefficient of the asset price, or otherwise known as a momentum. Sigma is the volatility of the asset price. It tells us the degree of uncertainty in the asset price. So when mu is positive, the price has an upward momentum, and we can expect the price to go higher. However, because of the volatility, which is quantified by the coefficient sigma, the price might end up lower. The probabilities of these outcomes will depend on the values of mu and sigma. In the first and the second lesson of the course, I will go into great details about how to find mu and sigma for a given stock, and how to use them to make predictions about the stock price. But before we can do that, I will need to tell you about the normal probability distribution, which will be part of the first lesson. So in the first lesson, we will first study the normal probability distribution in some details. In the upper picture, we are looking at the probability density function of the normal distribution. It is often called the bell curve by financial professionals. The center of the bell is a mean, or the average of the distribution. As I will show you in the course, the relative return of the stock investment often has a normal distribution. In case you're not familiar with this term, by relative return, I mean our profit or loss as a ratio of our total investment. For example, if we invest $10,000 and make a profit of $1,000, our relative return will be 10%. In this lesson, I will show you how we can make the historical prices of a stock, transform them, and fit the result to a normal distribution. Then I will tell you how the fitted normal distribution will help us build a GBM model of the stock price. We will do some Python programming using NumPy and SciPy for these purposes. Moreover, in this lesson, I will also tell you about the cumulative distribution function of the normal distribution. It is a curve in the lower picture. We will need it when we discuss risk management of our trading strategy. So in the second lesson of the course, we will discuss how we can make predictions about the stock price using the GBM model that we have built from historical stock prices. For this purpose, we need the log normal distribution. ST here in the formula has log normal distribution. it denotes the stock price at T hours, days, weeks, or months from now, depending on the time scale of our trading operation. And as you might have guessed, S0 here denotes the present stock price. In this lesson, I will tell you how the formula comes about, what it means, and how it translates to trading decisions. We will do Python programming to code formulas and generate price predictions. Also in this lesson, I will tell you about risk management, which is essential for any successful trading strategy. There are two prominent risk measures used in the finance industry. They are called the value at risk, abbreviated as VAR or VAR, and the expected shortfall, or ES for short. The first is a quantile of the profit and loss distribution. It tells us for a required confidence level, the size of the loss that we are confident will not be exceeded. For example, if 95% VAR of our investment is $1,000, we are 95% sure that if a loss is incurred, it will not exceed $1,000. The expected shortfall is generally considered a more rigorous risk measure, as it captures the fact that diversification in investment lowers the overall risk. It tells us, again, for a required confidence level, that if the VAR of the same confidence level is indeed exceeded, how much we should expect to lose. In mathematical language, it is a conditional expectation. In this lesson, I will show you how to compute the value at risk and expected shortfall and how to code them using NumPy and SciPy. Then in the third lesson, I will show you how to build an algorithmic trading program. It will comprise, firstly, an interface program that receives real-time prices from the market and that sends our buy or sell orders to the market. It will also need a database system to manage the prices data and facilitate access to the data from our analytics server, which retrieves the data, performs modeling, makes predictions, and finally makes trading decisions. And indispensable to all this is a risk management system that calculates the risk measures and determines the capital allocations. In this lesson, I will explain how these parts of the program fit together and tell you about some free and open source software packages that can help build the program. Finally, in the last lesson of the course, I will talk about testing and validating our trading strategy. It will involve backtesting using historical prices and scenario analysis using simulated prices. The purpose of the former is to make sure that had our strategy been deployed in the past, it would have made a profit. I will also tell you about the Sharpe ratio, which is widely used in the finance industry to assess the profitability of a trading strategy, and it is calculated from the result of backtesting. The purpose of scenario analysis is to find out, among others, if the stock price moves against us, how much we will lose. It is a test of our risk management system. The losses incurred in these scenarios must be consistent with what we anticipate from the risk calculations. In addition, we will talk about the student's t-test. It tests the significance of observed momentum and reduces the chance of being misled by false signals. So this concludes the course. If you have any questions for me, I will be more than happy to answer them. Thank you.